Only problem, I bought it from a fake seller.
James Dainard just walked over to my desk.
If you skip the first 3 steps, that's the easiest way to lose money.
Hi everyone, my name is Ashley Kehr. I am the co-host of the BiggerPockets Real Estate Rookie Podcast. I am here with James Dainard from Heaton Dainard Real Estate and Project Real Estate on YouTube. Today we are going to talk to you guys about hard money versus soft money. So James, can you please tell us the difference between the two? So let's start with hard money. What is that?
Yeah, so hard money and soft money is a financial tool that investors use to capitalize on investment. It's short-term financing to close your next deal. Hard money is really the traditional way of buying real estate investments. What it is, it's a short-term bridge loan where an investor's really...
Can you explain what a bridge loan is real quick?
Yeah, so a bridge loan is basically trying to get you from it could be for like a BRRRR style project. So on a BRRRR project, typically what you have to do is buy an investment that's in bad condition. It's not financeable. The hard money steps in, will give you acquisition financing and many times construction financing so you can do all the renovations, add the value, and then refinance into a conforming loan. So it's a bridge for you to get into permanent financing.
So this would be great for anybody who maybe doesn't have their own cash to buy a property, who can't get bank financing on the property because, it needs too much rehab.
Over or something like that.
Yeah. Bank won't lend on it. Is there any other reason somebody would use hard money?
Yeah, a lot of it sometimes comes down to structure too. So like on a BRRRR project, a lot of times people don't leave no money in the deal or leave very little. So a lot of times you have seasoning on that kind of money to where if you go buy a property with conventional financing, you have to wait 6 months and leave your cash in there for 6 months before you can refinance it out. Hard money, as long as if you structure your deal right, where if you got a hard money first and a hard money second, you can actually rate and term refi and pay that debt off a lot quicker than 6 months. So you can get all your capital back and get working on your next project. So it's not only about what kind of assets you're buying, it's about what you're trying to position and do with that asset. Sometimes it's worth paying the extra cost just to get yourself in the right debt situation.
What is a typical interest rate that you are paying on hard money? What are the terms for hard money? So it can vary, but what are you seeing in today's market?
So a lot of common loans, like in Washington State, it really depends on what market you're in, because each, California hard money might be a little bit cheaper. Washington, the standard rates are 10 to 12% and 1 to 2 points, depending on the duration of the loan.
And can you explain what a point is on a loan for everyone?
That's a great question. So that's it's an origination on the balance of your loan. So if you have a 1 point fee on $100,000, the lender's charging you $1,000 as an origination fee. So 2 points would be $2,000. Typically, they roll that into the loan, and so you don't pay it till the very end and you pay it off.
Okay, great. How can somebody find a hard money lender? If you've never used one before, how do you even find one?
So the internet is the best way to go, or referrals from other investors. Okay. And really, before you go looking online, you want to make sure that you need to use hard money, maybe not soft money, but then really dig down to what you're trying to accomplish. In my opinion, I only borrow hard money. Well, I only borrow hard money from interest funding because they're a local lender. The people that make the calls are not people to get appraisals. They know the market, they know the asset, and they'll be a lot more flexible with the vision I'm trying to implement. And so finding your local guys is always going to be a much easier much easier way to fund your next deal rather than going to someone nationwide and finding that they have to analyze a deal that they don't know.
If I'm going out and I'm finding a hard money lender, is it okay to just go into any hard money lender, or are there certain questions? Should I be interviewing them too to make sure they'll be able to close on my deal?
Yeah, you want to interview everybody that you put on your team, right? Like as you get involved in real estate, the goal is to build your bench of people that can help facilitate that transaction. So go out and talk to all the hard money lenders. And the questions that I would always ask a hard money lender is, the first one I want to know is what's their rate? What's their term? Are they going to give it to me for 5 months, or are they going to give it to me for 12 months, or do they have flexibility in that? And then what's their points? And then also if there's any other hidden fees. Not only am I asking what is their points, do you have an appraisal fee? Do you even do an appraisal? because they could say they're hard money, but if they're ordering appraisal, they're not true hard money.
Yeah.
Hard money guys lend on loan to value, not a bank appraisal. And then also figure out they have doc fees or construction loan fees. So then you know exactly what the cost of the money is and you can put it in your pro forma. The other really important thing for investors is knowing how to maximize your liquidity. So how much do you have to put down? And also, do they have an interest reserve? Because that all factors into how much cash you had to have out of pocket. And when I'm looking at a deal, I'm looking at what's my cash on cash return. So if the lender wants 20% and they want me to make all my payments with no interest reserve, that's more cash out of pocket. So I need to look at that deal a little bit different. If I have a lender that will let me do 15% down and have an interest reserve, that's less cash out of the deal. So that deal might look even better just on the structure I'm getting.
So it's just like bank financing. Go out and shop your lenders and see what they have available to you.
Yes. Shop your lenders. Also figure out what their pre-qual process is. Typically with hard money, it should be very simple. Most hard money guys actually don't care about credit. They want to make sure that you're not like a bankruptcy and that your loan can get trapped into an issue. But they're really not going to say, oh, do you have a 700 credit? Because they're really lending it to you based on your experience, your liquidity, and how good of a deal you're getting. So even if you have bad credit, you can still get into that next deal as long as you're buying the right thing and have the right experience.
Okay, I want you guys to go back and listen to that and those questions that he said that you should ask a hard money lender, and write those down, and then start calling, start emailing those hard money lenders and get one lined up. Even if you're not ready to use one right now, it's always great to have one on your team and available to you. So when that perfect deal does come up, you know who to call and you can close quickly. So let's talk soft money now. What is soft money?
So soft money, and those are two different things, and a lot of times I call it soft money. I don't think it's like a formal term, but I call soft money more, and there's nothing wrong with it, but I call them hard money lender, banks hiding in the hard money space, right? Because a soft money lender is typically going to be a little bit cheaper. They're going to be a little bit less in points, but they're going to take a lot longer to fund a deal, and then they're going to have more underwriting conditions that they have to accomplish before they can actually fund your deal.
So would you say that it takes a little bit longer than getting hard money, but a little bit faster than getting bank financing? Would you say that's the middle then, soft money?
I would say it's more in the middle, right? Typically a soft money lender is going to fund anywhere between 7 and 14 days, depending on whether they can get an appraisal, right? A lot of them have conditions. They're going to need to order an appraisal. If that appraiser can't get out there soon enough, that's going to delay the funding. So that's why it takes 7 to 14 days. If you work with a really good local bank, though, sometimes you can also fund that deal in 21 days, and it might be half the cost as well.
Okay. And what kind of asset would you use this? What kind of property would you decide to go with soft money instead of hard money?
So I use both, right? And as an investor, you need to maximize your tools. Know when to use hard money, know when to use soft money. I typically am going to use soft money on a property that's in better condition and where the seller wants more on the deal. Because there's nothing wrong with paying more for a property as long as you can structure it right. So if I'm going to a seller and I'm offering them $300,000 for this property and they're stuck at $320,000, maybe there's a way for me to bridge that gap without having to buy it cheaper. Cheaper financing saves me money, which allows me to offer more. So then I'm going to talk to that seller and see if I can get longer terms. Typically, I'm not going to make that offer no inspection, quick close with a soft money lender because it could put my earnest money and my closing at risk. So during that time, I negotiate on cleaner houses. I get a longer term, let them know how I'm paying for the property, and then I can actually pay more for it. So it's really, I use it on thin, cleaner deals. The other reason I use it on cleaner deals in better condition is because these soft money lenders do have an appraiser come out. That's a third party that might not look at that asset the same way that I'm looking at it. And then all of a sudden they have an opinion and it could affect my purchase price and my closing and the rehab amount because of this extra opinion. Houses that are in really bad shape, an appraiser's usually not used to looking at it, whereas an investor is. So it can cause a kink in your system if you don't have the right kind of asset you're borrowing on this.
And how would somebody find a soft money lender?
Again, you can go online. Now, soft money lenders are, and I think it's really important to qualify these guys when you're talking to them. There is tons of them out there right now, right? Because there's a lot of big banks. Big banks have figured out that hard money is profitable. But they can't really go out and say they're doing these loans because of the consumer lending laws. So they buy these other lenders or they make a screen on them. And so you can find them nationwide everywhere. But the questions you do want to go through, because each one of their processes is a lot different than a hard money. Most hard money guys are going to look at you, they're going to pre-qual you, look at the assets, give you approval, get docs to closing. Soft money is going to want to look at all your documents up front and actually pre-qualify you before you actually get approved. So when you go out and research these guys, you're going to find them all over the internet. You can find them everywhere. I would talk to investors more and find out who they've had good experiences with. Because if you find that really good deal and you lock it up and you go to closing and your lender can't get it done in time, you're going to lose your earnest money half the time, and you're going to lose that next potential investment, which you could be losing hundreds of thousands of dollars of profit. As a hard money lender myself, I actually enjoy soft money lenders because we get a lot of last minute loans.
Oh, yeah.
People calling us going, we got to fund. I got $200,000 in earnest money. I got to fund this right away. And we can get the docs done in 24 hours.
Get it done.
And so, research them online, get referrals, find out who has the best processes with the least amount of contingencies, then start working with them and dig down on their fees.
And when you say pre-qualify, so you can go to them ahead before even having a deal, get pre-qualified. So when you do have the deal, you're ready to close.
Yes, and every investor, before you get out and start shopping for a deal, a good deal is only good for like 12 hours, right? Our typical time frame for us buying a property is we see it, we contract it within 3 hours of looking at it, or within a day period.
Yeah.
So there's not a lot of time to go then call my mortgage guy or call my soft lender guy or call my hard money guy and get pre-qualified. My hard money guy I always know will fund because I'm putting down a certain amount and I'm buying a good deal. Soft money, they still go through the same process as bank financing. You're going to need to submit your tax returns, you're going to need to submit your credit score, so it takes a little bit of time. So before you look at any deal, you might miss it even if you find a good one. Make sure you get pre-qualified.
Okay, well, I'm really interested in seeing some properties that you have. So maybe we could go to 2 properties today and look at one that you used hard money for, and one for soft money, and we'll go on an adventure. Okay, guys, we made it to one of James' properties, and as you can tell, he buys beautiful houses here. We got private property, keep out. So James, is this a hard money house or a soft money house?
This is a hard money house. The reason,
and why?
there's a lot of reasons why it's a hard money house. So the biggest reason is we had no access. We got sent this property. It was a really good deal. The price on it was $230,000. We knew the value was $500,000, but it came with a list of contingencies and problems that we couldn't get inside.
Why couldn't you get inside?
Well, because we had 15 tenants in there.
15?
15 tenants. None of them have paid rent in over a year.
Oh my goodness. So this seller was really motivated to get rid of the property.
Yes, the seller wanted out. She said, basically, it was her son's friends that had moved in. Became a huge problem for her. She didn't know what to do, and she wanted to sell it immediately. Okay. But she wanted it in and out, and she didn't want to have to deal with her friend or her son's friends.
So instead of going to conventional money or soft money, where you would have had to have an appraiser go in, which you just said you can't get access, you went for hard money.
Yeah, we had to use hard money. Because when you have unique, weird situations or property that need a substantial amount of work, soft money's not an option because they need to get their appraiser inside, they need to look at the condition, and they're going to look at the comparable data.
So I hear airplanes overhead. I mean, literally every 30 seconds it seems.
And in areas that have planes or negative impacts, you're going to get 2 different data sources. You're going to get really high comps and you're going to get really low comps. So if your appraiser comes in with a low value, your really good deal is going to disappear because you can't fund it on time.
Well, you guys, thanks for joining us at this hard money house. We're going to head over to the soft money house. But before we do that, I just want you guys to look down at these beautiful roses that James presented to me upon arrival of the property.
We're going to pin you.
Oh.
We're going to pin you. Oh, excuse me. A little bit of smegma left on there.
I'm so pretty. This neighborhood is looking a little bit different to me than the last one.
No planes.
Yeah. Why is this a soft money house?
So this is a great soft money house because the condition was in a lot better shape. The neighborhood's good, the comparable data was good, and it just was in a financeable condition, whereas the other one needed a ton of construction work.
Okay, so where did you get this deal from?
So we actually got it from a wholesaler.
Okay.
He sent it off to us. One thing he let us know was the seller wanted a higher. He was a little worried about the price. It was it was expensive price. It was $1.175 million to purchase, and also the seller wasn't in a hurry, so he didn't want a quick close. He wanted us to be a little bit more flexible.
Okay, so with the difference between hard money is more like doing a cash offer where it's just here's the money, you can close quickly. But with the soft money, you still have to have an appraiser come in, and it's more like conventional. So how did that affect your offer on this property?
So really what affects the offer is the rate and the points. And so we put that into our financial profit calculator, and we run it based on that. So it tells us that we can pay a little bit more. So when we're paying roughly 5% less on our interest and half the points, we can actually put that savings back in the deal, which allows a more expensive, tighter margin deal to make still profitable sets. Okay,
and then with the seller, how do you negotiate with them for them to wait a little bit longer, or just because the seller wasn't in a hurry, you knew it wouldn't be a big deal?
And that's a great question. So in this specific example, we had the time, and the lady was very flexible with the closing. But when I'm talking to a seller, it's always about trying to understand what their goals are and what our goals are, and then properly explain it to them as well. You know, when you're working with a seller, you don't need to tell them, give them a situation that's not true. It's a, hey, you're a buyer, I'm a seller, we're trying to meet in the middle here. So there's different ways that we can do that. If they give us more time, so when people ask me for a high price, the first thing I ask for is, are you okay giving me, instead of doing a 1 week close, can I get a 2 to 3 week close? And are you okay if I bring an appraiser in? One thing you can do to still make sure that your offer's strong, because you don't want to just come in and say, hey, if it appraises, I can buy it.
Yeah.
What you can do, what we do is with our soft money offers, we still write it, let them know that we're bringing an appraiser out, but we waive financing contingency. Because then they still feel like they want to do the deal with us and they're qualified. So we're giving them the earnest money. We're saying, hey, this is going to close no matter what, and we're going to waive the financing, so then they know that we're still for real, but we're still going through the same process.
Okay, awesome. That's great to know, and a great tip for anybody who is using soft money or just on making offers in general as to which kind of houses you should use hard and soft money for.
Yeah.
Okay, well, thank you guys so much for joining us. Make sure you subscribe to the channel. Leave a comment below and let us know if you used hard or soft money before, and how are you financing your deals. Follow James at JDaneFlips on Instagram, and myself at Wealth from Rentals, and we'll see you guys next time.